So we can start. Today we said we'll be doing what? Employment income, employment benefits. Yeah, employee benefits. IAS 19. I'll share the notes under impairment of assets. Yeah. It was under the impairment of assets. Alternatively, take out your handout. Also, in your handout page 33. Handout page 33. Let's discuss on that. So employee benefits. And employee benefits refers to just all the benefits given to an employee by an entity for their services offered. For example, salaries, wages, commission, fringe benefits, they are all part of employee benefits. So what are the sum of the types? So let's look at the various types of employee benefits. And employee benefits are classified into four. Number one, we have termination benefits. Termination benefit. Number two, we also have short-term employee benefits. Also, we have long-term employee benefits. And number four, we have also what we call retirement or post-employment benefits, which are also the pensions. So for the termination benefits, they are benefits payable upon work being terminated by either the employee or the employer. That's what we call the termination benefits. Yeah, what you are you're being paid when the work is being terminated by the employer or the employee. What do we call them? Severance fee. In most of the organizations, they are supposed to pay how many months? In case you are laid off, 3 months. Yeah, mostly they are paid the salary that you're supposed to be paid for the next 3 months. Now that's what we call the termination benefits. Then we have the short-term employee benefits. Those are all benefits payable within a duration of 12 months or 1 year, such as salaries, wages, commission, quarterly bonus. Sorry? Leave allowances, even free meals. They are part of employee what? Short-term employee benefits. Then we have long-term employee benefits, and they are benefits which are not settled within 1 year, such as what? Sabbatical leaves. We have sabbatical leaves. Then we have what? What are sabbatical leaves? We have of sabbatical leaves. You can Google. Can you Google it now? What sabbatical leaves? They are more of like traveling holidays. Yeah, or either you take an education holiday. That's what we call sabbatical leave. Then lastly, of which this way we want us with our focus on is the retirement benefits or the post-employment or the pension. And those are the benefits which are payable upon retirement. And the benefit payable upon retirement, they are paid in terms of what? That's why you say that he is a pensioner. That means what? An NSSF graduate. That means you have reached the retirement age. So what you are paid, they are called the retirement benefits, which are paid in terms of pension. Now, when you talk about the pension, what are some of the types of pension plan? And we have two types of pension plan. Number one, we have defined contribution plan. Number two, we have defined benefits plan. So what's the difference between the two? So now let's not write the notes. You have them. I'm trying to summarize them. So defined contribution plan. Now these are the employment of the benefits payable upon retirement, or the benefits which will be payable upon retirement will depend on the amount of contribution you made to the plan during your career life. Are you together? So we are saying that under defined contribution plan, under this plan, the amount payable upon retirement will depend on the amount of contribution made into the plan by both the employee and who? Employer. Good. Then, an defined benefit plan, the amount payable on retirement will depend either on the average salary, or the final salary. But this determination will be based on the actuarial assumptions. Actuarial assumptions. And for actuarial assumption, we'll be looking at either the financial, we have the financial assumptions, and also we have demographic assumptions. Yeah, we are saying that under defined benefit plans, the amount payable will be based either on the average salary or the final salary, but the computation will be determined on what? Actually what? Assumptions. And actual assumption can either be financial assumption or demographic. When we talk about financial assumptions, we are looking at things like expected rate of return, things to do with the inflation, interest rate, etc. When you talk about the demographic assumptions, we are looking at the claim rate under the medical plans, also rate of labor turnover, also mortality rate, So now let's go back to our notes now. So we are looking under types of pension plans, and we have the defined. So now let's go through the defined contribution plan. And the pension payable on retirement usually depend on the contribution paid into the plan by the employee and the employer. Under this scheme, the employee bears the uncertainties of the amount that will be paid upon what? Retirement. Why? Because the amount will depend on the performance of what? The investment. Yeah? We are saying that under this contribution plan, the amount payable will depend on what you contributed in the plan during the career life. Now, assuming you contributed 4 million, that's what you contributed during your career life. So how much do you expect to receive upon retirement? You receive? How much do you expect to receive? If you contributed 4 million during your career life, you'll get? 4 million plus what? Interest, or let's just call them return. That's why you're saying that under this plan, the employee bears the uncertainty of the amount receivable. So what you are sure is that you had paid 4 million. Are you together? So you must receive back your 4 million. But remember what usually happens, what you contributed during your career life, what the pensioners usually do, I mean this pension plan, they invest that amount. Once they invest the profit they get, they have to share with you because number one, they invested using your money. So what they get in returns, they have to share with you. So you get 4 million plus the returns. So we are saying that now this return, the employee will bear the uncertainty because the return will be based on how the performance of the investment was performing. So good. Now let's go to the second one, the defined benefit plans. And a defined benefit plan, the pension payable on retirement under this plan will depend either on the final salary or the average salary of the employee during his career. The calculation will be based on the actuarial assumptions, such as they might decide to take your average salary, for example, on an yearly. The average salary is not on a monthly, they usually take on an annually. So per year, on average, how much were you earning? For example, let's assume it's 2 million. Then how many years have you worked? Maybe 20 years. And then they decide that number of years times the average salary will need to pay you only a third or 2/3 of that amount. How do they determine that 2/3? You're saying that now that 2/3 is what will be determined now using the actuarial assumptions. There is a lot of factors they need to consider. So what are those actuarial assumptions? Actuarial assumptions comprises, we have demographic assumptions, and these assumptions are about the future characteristics and of the current and the former employee, and they are dependent. Demographic assumption deals with matters such as mortality, both during and after the employment, rate of employment turnover, claim rate under medical plans, and then we have the financial assumptions. So the financial assumptions, what do they look at? Discount rate, future salary and the benefits level, expected rate of return on plan asset. Good. Let's go to the other page. Now we look at measuring defined plan asset and liability. Measuring defined plan asset and liability. How do we measure assets and liability? So the motive of measuring, it's all about making evaluation. You're comparing the carrying amount against the fair value, so that the difference you can get what you call the remeasurement changes, which can either be actuarial gain or actuarial loss. So we'll come back to that. Now let's go there where you have the multi-employer plan. Multi-employer plan. Are we there? What do we mean by multi-employer plan? Now, small entities do not have resources to run the pension in-house. It pays pension contribution of an insurance company, which runs a multi-employer. That is a pension plan for several employers. That's what we call multi-employer plan. It's just a pension plan for multiple employers. Then we have what we call the funded scheme. So what's the difference between the funded scheme and unfunded scheme? Now, for the funded scheme, it's a plan which the employer transfers the contribution to an external entity. Actually, do you usually make contribution to NSSF? Now, that's what we call the funded scheme. The funded scheme. So in that case, you are transferring those resources to an external entity. Then we have big organization, mostly the insurance company and the banks. So for them, they know how to manage their funds. So for example, Equity, they might decide that we have over like 2,000 employees. So instead of submitting that amount to NSSF, why don't we come up with our own benefit plan or a plan where you can be managing that amount? In that, if you retire, you go to claim from them. Are you together? So now that's what we call unfunded scheme. Unfunded scheme, where the amount will not be transferred to an external entity, rather the amount will be retained within the organization and then reinvested. So that mostly happens with the insurance company. Insurance company don't transfer that amount. So they usually come up with their own pension fund in the entity. They just form, they have their own fund manager. So all the contribution will be transferred to that. And then from there, they can be able to invest using that amount. Then let's look at unfunded scheme. That's what I was explaining. You don't, in this case, you don't transfer to an external entity. Rather, you retain them and then you invest them. So unfunded scheme, this is where the contributions are not transferred to an external entity. Rather, they are retained in the company and reinvested in the business. Good. Then we have funding. What do we mean by funding? So you go through that. So now let's go back where we had measuring, define plan assets and liabilities. So how do we measure plan assets and liability? So you're saying that in this case, you'll be comparing the carrying amount. What is the carrying amount? You said what's the carrying amount? The accountant, we never say. Yeah, it's almost the same as net book value. The amount shown in the financial statement. Now, in this case, we'll be comparing now that carrying amount against the market value. You determine whether there is a gain or whether there is a loss. Now, that gain or loss is what we call the actuarial changes. Let's start with the asset. How do we measure an asset? So, defined plan asset. So, how do we measure defined plan asset? So, in this case, we'll be taking the fair value of plan asset, balance brought down. Then you add contribution to the plan. Yeah, what you contributed to that plan increases the value of your asset. And then also you add return on plan asset. Any income generated from that investment increases your value of your asset. Then you deduct the amount of benefits paid. The benefit will reduce the value of your asset. Now, what you get is our carrying amount. Now you'll be comparing the carrying amount against now the market value at the end. Fair value, balance carried out. Now, the difference now between the two is what now gives rise to actuarial changes, of which can be either the actuarial gain or actuarial what? Actuarial loss. What about for the liability? So how do we measure defined plan liability. For the defined plan liability, you usually take the present value of obligation balance brought down. Then you add, liability gives rise to expenses. So you add current service cost, past service cost, and then you have the interest cost. So take the 3. Then you deduct benefits paid. Now the benefit paid, the amount you deducted from the assets, and the liability should be the same. And that's how now you get the carrying amount. Now you compare the carrying amount against the market value at the end. So present value balance carry down. So the difference between the two, it gives rise to actuarial changes, which can be either an actuarial gain or actually what? Actuarial loss. That's how we measure that. And where do we report this actuarial gain or actuarial losses? Now, actuarial gains and actuarial losses, they are reported under other comprehensive income. Are you together? Under other comprehensive income to the income statement. So now let's do some illustration. We'll do some illustration. Check out your past paper. September 2015, question 4A. September 2015, question 4A. So we are told that Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan asset was 2.6, and the present value plan liability were 2.9. That's on 1st January. Those are opening balances. The balance brought down. So for the asset was how much? On 1st January 2014, the fair value of the pension plan asset was 2.6. That's the balance brought down. And the present value of plan liability was 2.9. So the balance brought down for the liability was 2.9. Then you're told that second paragraph, they actually estimate the current and the past service cost for the year ended that 1st December 2014 at 450,000 and 90,000 respectively. So we are given the current service cost and the past service cost, 450 and 90. The past service cost is caused by an improvement in pension benefits commencing that 1st December 2014. The pension plan paid 240. The pension plan paid 240. What is that? Benefits paid. Good. We say that you deduct the benefits paid 240 from both the assets, from the liability. Benefits paid 240. Yeah, the pension plan paid 240 on that 1st December 2014. And on the same date, Volta Limited paid 730 in contribution to the plan. So contribution to the plan was 730. Good. Then you're told that interest rate on high quality corporate bond for the year was how much? 8%. The interest on high quality corporate bond, 8%. So that means if you invest on a corporate bond, you expect a return of how much? So a return on plan asset, you will take 8%, you multiply by what you had invested at the beginning of the year, balance brought down to 26. Then the same for the liability. For the liability, you'll be paying what? Interest. So you take 8% of the balance brought down, which is 29. How much is for the asset? 28. 8% for the liability is an amount of 230. 232. Good. Then we are told that as at the year end, that's the end of the year, the fair value of pension plan asset was 3.4 and present value of plan liability was 3.5. What are those? Those are the balance carried down. We are given both for the assets and for the liability. For the asset was an amount of 3.4 and for the liability was 3.5. 3.5. Then you are told that in accordance with year 2011 revised IAS 19 employee benefits, Volta Limited recognizes measurement gains and losses, those are the actual gains and losses, in other comprehensive income in the period they occur. Required. Calculate the measurement gain or losses on pension plan assets and liability that will be included in other comprehensive income for the year ended that 1st December 2014. So give me the carrying amount for the assets, give me the carrying amount for the liability. This one is 30? That's 298. What about for the liability? That's 430? 2. Now let's be here. Let's start with the assets. The carrying amount of the net book value is that 298, but the market value is 34. So there is an increment of how much? Is that 102? 102. What do we call that? An actual what? Yeah, that's an actual gain. We do the same for the liability. From 3432 to that 500, that's an increment by 60 what? 68. An increase of 68. That's an actual what? It's an actual? Yeah, it's an actual loss. When liability increases, becomes a loss. So therefore, how much will be our net actual changes? For the net actual changes, we had an actual gain of 102, but you minus, there was an actual loss of 68. So what do we take to other comprehensive income? 30? Yeah, this goes to other comprehensive income. Yes, you're excused. Yes, it's commencing at the end of, but we have to provide for it. Yes. Good. Did you print the notes? Let's start from that point. Did you print the notes? I'm not asking about the handout. The notes. I had shared the notes on impairment of assets. You have that? Yeah. That for the impairment of assets, the notes, they share the notes. Employee benefit is co-condemned. So don't have to copy them. You already have them. You don't have to worry. You'll copy them later. You'll take a copy. First of all, understand what we are doing. So I want you to be looking at this question. Yeah, do it in your book now. I want to May 2019. May 2019. Question 3A. May 2019, question 3A. We take a break of 3 minutes. I'm the one taking the break. And our Muslim brothers, so they can pray. The rest of you, can you be doing that? So W Limited, a public limited company, operated a defined benefit pension plan for its employees. The present value of the future benefits obligation as at 1st January 2018 was that 80. That's the present value of obligation. So we had that 80, and the fair value of the plan asset was 2860. Further information relating to the pension plan for the year ended that 1st December 2018 was as follows. Current service cost 209. Benefit paid to former employees 242. So benefits paid is 242. Benefits paid 242. Contribution paid into the plan 259. Present value of benefit obligation as at that 1st December 2018. Those are the balance carried down. 3360. And the fair value of plan asset 13. Additional information. Interest cost. Gross yield on blue chip corporate is 5%. So interest, you take 5% of the balance brought down. That 83 divided by 2, you get 154, right? Number 2, on 1st January 2018, the pension plan was amended to provide enhanced benefit with effect from that date. The present value of the enhanced benefit as at 1st January 2018 was calculated by actuaries as 110. That's what we call the past service cost. And the past service cost was an amount of 110. That's what, not what you have done. Eh? And also, we have not yet provided the return. Are you given the return? Sorry, the return on plan asset, you take 5% of 2860. So that is 143, right? 143. Give me the carrying amount. This one you're getting an amount of 20. And this one you're getting? Yes. You did not interpret 110 well, I can tell. Eh? You get? Sorry? 3311. Now let's compare the changes. This change from that 20 to that 113 is an increment, right? Therefore, it's an actuarial gain out of an amount of sorry? 83. Unasema nini? 93. What about this? From that 311 to that 360, it's an increment. Eh? So an increased liability becomes an actuarial loss, an amount of 49, an actuarial loss. Therefore, our net actuarial changes will be, we had a gain of 93 and we had a loss of 49. So how much do you take to other comprehensive income? 44, eh? That's what you're supposed to do. So you can try, still try another question. December 2012, question 4B, or question 4, December 2012, question 4. Part B of the question, the Wanda Industry Limited operates a defined benefit post-retirement plan for its employees. The plan is reviewed annually. The company actuaries have provided the following information. So you are given the present value of obligation as at that 1st October 2011. That's liability balance brought down, an amount of 15. Then we have present value of obligation as at that 1st October 2012. That's the balance carried down, 1750. Then you are given fair value of plan asset as at that 1st October 2011. The balance brought down for the asset was 1500. And the fair value of plan asset as at that 1st October 2012, 1650. That's the balance carried down. Then you have current service cost, 160. Current service cost we have is 160. Contribution paid, 85. So contribution to the plan, it's 85. Benefits paid to employees, 125. So benefits paid is 125, you deduct. Benefits paid, 125, you deduct. Then we have net cumulative and recognized gain. That one does not affect that. Additional information. The expected return on plan asset as at 1st November 2011 was 12%. So return on plan asset is 12%. So you take 12% of the balance brought down, 15. Forget? 180. Then number 2, the discount rate for plan liability as at 1st November 2011 was 10%. Discount rate of liability. So that's interest cost. You take 10% of the balance brought down, which is 15, and you get 150. Number 3, the average remaining working rates for Wanda Industry Limited employees as at that 1st October 2011 was 10 years. Required. Extract of the Wanda Industry Limited financial statement for the year ended that 1st October 2012. So give me the carrying amount. Give me the carrying amount. $1640. 1685. Let's start with the asset. From 1640 to 1650, there was a gain, an increment of 10. So that's the actual gain. Liability, 1685 to 1750. There is an increment of how much? 65. Increase. So therefore, it's an actual what? Yeah, it's an actuarial loss. Good. So give me my net actuarial changes. So we had a gain of 10 minus a loss of how much? 65. So how much do you take to other comprehensive income? Negative 50. Negative 55. Are we okay? Yes, but we have not answered the question. What was the question? Extract of financial statement. That's the income statement and the balance sheet. Actually, what we have done, now the measuring of asset and liability, this goes to the notes to the financial statement. So what do we take to the income statement? So we come up with the extract. The Wanda Industries Limited income statement extract for the year ended that 1st October 2012. So to the income statement, what do we take as part of income? Income comes from the asset. Are you together? So you expect income to come from the asset. So from the assets, what do you think will go to the as part of incomes? Yeah. What do you think will go to incomes, to the income statement at a part of incomes? Actuarial? Actuarial again. What else? Contribution. None of the above. Actuarial gains, we have said that it goes to other comprehensive income. That's after you get the profit. So it does not go to the income. Contribution is what you invest to get returns. Are you together? So the return on the plan asset is what goes to the income. So return on plan asset, an amount of 180. Then we go to the expenses. Liability gives rise to the expenses, and the liability we had 3 expenses. We have the current service cost, past service cost, and interest cost. So bring your current service cost, past service cost, and then interest cost. How much was the current service cost? We have 160. There was no past service cost, and interest is an amount of. Now, if you take the returns, you minus the expenses, what you get is the net pension cost. Net pension cost. So give me that. Is it 130? Don't write this as a negative. Are you together? Provided you have said it's a net pension cost. Net pension cost. Then that's now when you factor in other comprehensive incomes. And other comprehensive income, you bring your actuarial changes. Actuarial changes. How much was it? Negative 50? Negative 55. Let's go to the balance sheet extract. Viwanda Industries Limited. Statement of financial position. Extract as at 31st of October 2012. So we have the assets, non-current assets. Under the non-current assets, we have defined plan asset. Defined plan asset. How much? Just go to the defined plan asset. What do you take to the balance sheet? 1650. Good. You just take the balance at the end. Then we go to the equity and liability. Under the equity and liability, we have a reserve. The actuarial changes. They are the same as evaluation reserves. So you bring actuarial changes, an amount of 55, but a negative. And then under non-current liabilities, we have defined plan liability. How much was it? Yeah, 1750. That I will show that. It's just an extract. Or alternatively, you can do this. Alternatively, you compare the asset 1650 and the liability. Which one is more? Liability. So instead of showing non-current assets, you just show equity and liability. You show the actuarial changes, and then you show a net liability. Are we together? So you take 1750 minus asset of 16. So you show a net of 100. If the asset were more than the liability, you show a net asset. Are we together? So you can choose to use any, but you can use this. That's the easiest. That's how you are getting your 14 marks. Let's go to part A of that question. Part A, that was part B. Part A. So part A, you are told that in the context of IAS 19 employee benefits, evaluate, number 1, when an amount should be recognized as a defined benefit, liability. That's what I've just explained. Okay. When should you recognize a net liability? That's the last item I have explained. Sorry? When? Correct. As simple as that. When the net liability and when the liability are more than the assets, that's when you show a net liability. Or you can also say that when the assets are not enough to settle off the liabilities. Are we together? Yeah, just say that when the liability are more than the asset, that when you show a net liability. Then number two, the treatment of actuarial gains or losses. How do you treat them? How do you treat the other compressed? Just giving you the answer. Eh? How do you treat them? Yeah, you treat them under other comprehensive income. That's the statement of comprehensive income. And as a reserve in the statement of financial position. Yeah, you see in the statement of financial position, you have recognized as part of reserves. Yeah, as part of other comprehensive income and as a reserve to the statement of financial position. Number three, the item that should be recognized in the income statement. The items that should be recognized in the income statement. Hiyo ni kazi ya macho. Hapa hakuna kitu ya kufikiria. What have you taken to the income statement? Actuarial gain, very wrong. Even actuarial changes, no. Yeah, we have return on plan asset, current service cost, past service cost, and the interest what? Cost. They are asking about the income statement. Other comprehensive income. We have income statement and statement of comprehensive income. They are totally different. So actuarial changes, that goes to statement of comprehensive income. But they have asked what do we take to the income statement. So it's the return on plan asset, current service cost, past service cost, interest cost. And you get your 20 marks. Let's try another question. December 2017, question 2C. December 2017, question 2C. December 2017, question 2C. And that question. The following information was extracted from the books. So we are doing December 2017. Question 2C. The following information was extracted from the books of Comfort Retirement Benefit Scheme for the year ended that 1st October 2016 and that 1st October 2017. Discount rate on 1st November, you were given that. Expected rate of return on plan asset, average remaining service, right? The fair value of plan asset, 1st November. So those are balance what? Balance carried down. You have an amount of 96 and 110. Present value of plan obligation, that's liability. Those are the balance carried down. 100, 125. Current service cost, 810. Current service cost, we have 810. Benefits paid, 1512. Benefits paid, 1512. Benefits paid, 1512. Contribution to the scheme, 911. 911. Past service cost, 4 dash. Additional information. As at 1st November 2015, now we are told that the year ends on that 1st October. So if the year ends on October, that means the financial year started on November. So here you have 2016 and 2017. 17. For year 2016, that means has started on 1st of November 2015. Good. Number one. As at 1st November 2015, the present value of plan obligation and the fair value of plan asset were both how much? 100. So the balance brought down for both asset and liability was an amount of 100. Number two, assume that all transactions occurred at the year end. Discount rate on 1st November. So the discount rate will give rise to the interest cost. 2016, the rate was, you take 10% of how much? The balance brought down, which is 100, and you get an amount of 10. Then 2017, the rate is how much? 8. So you take 8% of the balance brought down. How much is the balance brought down here? Are we given? How much is the balance brought down? Good. 100. The balance carried down for 2016 becomes the opening for 20. The same for the assets. 96 becomes your opening balance. So here you get 8. Then below it we have expected rate of return on plan asset. The expected rate of return on plan asset. So return on plan asset, 2016 the rate was 12% of the balance brought down, which is 100, of which you get 12. And then we have 10% of 996, and you get 9 point. Give me the carrying amount. $121, you get 106. This one is 104.104.6. What about this? 112, 122 minus 7, 107. 107, eh? This one is 106, eh? Now, let's get the actual changes. 2016, we start with the asset. From 106 to 96, increase, reduction. A reduction of how much? 10. Let's just call them actual changes. Let's show it as a negative. What about this one? From 104 to 110, increase, decrease. An increase of how much? 5.4. So it's an actuarial gain. That's why I have just indicated actuarial changes. So since we have 2 years, you can show a loss as a negative, that one as a positive. We do the same for the liability. We get actuarial changes. 107 to 100 is a reduction, right? Reduction becomes a what? A gain. 106 to 125, 19. That's an increase. Increase becomes a what? A loss. So that means our net actuarial changes we have here 2016 and 2017. So 2016, we had a gain from the liability of how much? 7, but we had an actuarial loss here, 10. So we have a net of -3. 2017, from the asset, we have an actuarial gain of 5.4 minus, we had a loss of 19. So you get -13.6. Let's go to the required. Required number 1. The actuarial gains or losses, we already have that. Number 2, the net pension cost to be charged in the income statement for each of the 2 years. Did I show you on how to get the net pension cost? Yes, number 2. So you have here 2016, 2017. How do you get the net pension cost? You just take return on plan asset, then you deduct the expenses. Current service cost, past service cost, and the interest cost. And that's how you get the net pension cost. And the return on plan asset, we had an amount of 12 and 9.6. Current service costs, we have 8, 10. Past service cost, we have 4 dash. And then for the interest cost, we have 10, 8. 12, 12, you get 10, right? What about that? 18 minus 9, you get 9 point. 8 point. Hakuna negative. See that for the net pension cost. Just show the amount. Number 3. Balances to be reflected in the statement of financial position. What do we show to the balance sheet? In this case, we'll be having how many items? 3 items. So to the statement of financial position, under the non-current assets, you show defined plan asset. So 2016, 2017. Defined plan asset. So you have 96 and you take the balance carry down. Then under the equity and liabilities, under the equity, we have actuarial changes. They are part of reserves. 20s, we have 3, and we have 13.6. And then under the non-current liabilities, we have defined plan liability. And we have an amount of 100 and 125. As simple as that. Assignment, just write it somewhere. June 2012, question 3B. June 2012, question 3B. So that's measuring defined plan asset and liability. Let's go back to the handout. Now we look for accounting and reporting by pension plan. This was accounting. So how do they report? So assuming now the way you have said that, I will say that for the example for the banks and the insurance, they have their own plans. Assuming you are the accountant there, in that case, you want to determine whether they are operating at a surplus or deficit. How do you prepare the financial statement? That's the income statement and the balance sheet. So the income statement, they call it as a statement of changes in net assets. And then in case it's a balance sheet, it's known as the statement of net asset. Yeah. So you go back to the handout page 36, handout page 36. Where you have the accounting and reporting by retirement benefit plan. That's IAS 26. So the pension entities usually prepare the following statements. One is a statement of changes in net asset or fund account. That's the same as the income statement. Number two is a statement of net asset. So that's a statement of financial position. And I've given out the format there. Now, being a pension fund, assuming you're running a pension fund, what do you think are their major income? For example, in an insurance company, we know are the premiums. And their expenses are the claims. For the banks, you know the income is what? Interest. Now, to the pension plan, what do you think are their major incomes? Yeah, is the contribution that you make. So contribution to the pension plan becomes an income to them. What do you think are their major expense? The pension. After all, you are contributing so that you can get the pension. So the pension and the benefits paid are their expenses. So now we have the format. Let's go through that format. For the statement of changes in net asset, that's the income statement. Their major income, we have contribution by both the employer and the employee, transfer from other scheme, and investment income. Under the expenses, they have the pension and other benefits, admin expense, transfer to other schemes, and then other expense. Then pension plans, they don't operate with an objective of making profit. Are you together? Yeah. So in case the inflow are more than the outflow, they record a what? A surplus instead of profit. In case the outflow are more than the inflow, they record a what? A deficit. Let's go to the other side. Statement of net assets. That's a statement of financial position. So now in this case, what they usually do, the way you have been used to prepare the financial statement, assets and then equity and liability. This one is you get the net asset. How do you get the net asset? Is the asset minus liability? So you'll be taking assets, you raise the liability, and then you show funded by. So in our asset, we have investments, PPE, and the current assets, we have the contribution receivables, cash at bank, then contribution due in days. Then you deduct liabilities, such as pension payable, accruals, and that's how you get the net assets. Then you say financed by. Now, for them, they don't have capital or equity. They don't issue share. So in case they are capital, they call it accumulated what? Accumulated fund or accumulated surplus. Good. So there is an illustration there. Illustration, let's go through that. The following trial balance was extracted from the accounting record of K Retirement Benefit Scheme for the year ended 30th October 2016. Accumulated fund, what is that? Financed by, it's the same as capital. Adika C hapo. That's right, see, that means capital. Accrued expenses. It's not an expense. Accrued expense is a liability. Accrued expense is not an expense. It's an expense we have already incurred and we have accounted for it, but yet we have not yet paid. Therefore, it's a current liability. Admin expense. Cash and demand deposit. Current assets, it's an asset. Loss of value of investment. Loss of value of investment. That is what? Receipt? What are you saying? Sorry? Expense, loss of value of investment. Liability. Other Kenyans. What is that? Now, let me ask you a question. What is depreciation? I know it's an expense. I'm asking. What's a depreciation? Loss of value of an asset. Now, can you use that concept and go back to the question? Loss of value of investment. What is that? An expense. In short, I only converted that name from depreciation. I just wrote something to confuse you. Loss of value of investment. In short, that's what we call depreciation. Therefore, it's a what? It's an expense. Lump sum retirement benefits. It's an expense. Yeah, we have said that all benefits and pension, they're expenses. Then contribution due within that days. Yeah, current. It's a current asset. It's contribution we expect to receive within the next that day. So it becomes a receivable. Employer's normal contribution. It's an income, good. Individual transfer in from other scheme. An income. Individual transfer to other scheme. Expense. Investment income. Income. Immovable properties. Yeah, they are non-current assets. They are under buildings. Then we have Kenyan government securities. It's an non-current assets. Good. Members' normal contribution. Income. Members' additional voluntary contribution. Income. Pensions. Expense. Quoted equity investment. Quoted equity investment. Quoted equity investment. Funded by current asset and current asset. Now let's set on one. Quoted equity investment. Current what? No, quoted equity investment is an uncurrent asset. All investment are an asset. Are we together? Then we have unpaid benefits. They are liability. Unquoted equity investment. If the quoted is an uncurrent asset, therefore unquoted equity investment is a what? Very wrong. It's still an uncurrent asset. What's the difference between quoted and unquoted? Quoted, that means you're investing in shares of a public company. Unquoted, you're investing in shares of a private company. That's the difference. Both of them, they're non-current assets. Yeah, quoted, you're investing in shares of a listed company in NSC. But for unquoted, you're investing in shares of a private company. Required. Statement of changes in net asset. Number B is the statement of net asset. And you have the solution with you there. So, good. And that's the end of that topic. So in our next session, the handout I shared on impairment loss, we will still be using the same handout. Yeah. So we shall be doing on impairment of assets. Actually, in our next session, God willing, we might do two topics: impairment of assets and also financial instruments. So I'll share the handout on financial instruments.